If you pay taxes, expect a refund, or file with the IRS every year, do not skip this video. The IRS has rolled out fresh guidance for the 2026 filing season, covering tax year 2025, and it's packed with shifts in rules, potential holdups in getting your money back, and ramped up oversight that might hit your wallet harder than you think. One specific tweak, tied to new legislation like the One Big Beautiful Bill, is already sparking issues with refunds for countless filers. Think millions who could see delays or reductions without seeing it coming. I'll dive into the nitty-gritty of what's evolving, why it matters to everyday folks like you, and practical steps to shield your finances before problems pile up. Let me set the record straight right away. This isn't guesswork or a rant about politics. Everything here draws directly from official IRS announcements, like their October 2025 inflation adjustments and the provisions in the One Big Beautiful Bill, which amends key parts of the tax code starting this year. In short, these are concrete updates from the agency itself, not hearsay. The real risk? A single oversight under these refreshed guidelines could ding you for hundreds or thousands in unexpected costs, and the average taxpayer might not spot it until their return bounces back with issues. Hang tight, because I'll unpack each major shift layer by layer, with real-world examples and actionable advice to keep you ahead of the curve. Let's kick off with the first big shift: how refunds are timed and handled. For decades, we've all gotten used to a smooth routine. E-file your return, opt for direct deposit, and bam, your cash shows up in 2 to 3 weeks. But that's no longer a safe bet. The IRS is beefing up its automated fraud detection tools, pulling from a wider net of data to verify everything before cutting checks. This isn't just about catching crooks. It means even spotless, honest filings could get stalled while the system double-checks. Picture this. Your return gets compared against employer W-2s, bank 1099s for interest, past returns, and even identity markers from government databases. If there's the slightest mismatch, like a W-2 arriving late or a bank report off by a day, your refund freezes for manual review. It's not an audit, and it doesn't imply foul play. It's just the new normal for enhanced verification. For 2026, this setup is scaling up thanks to tech upgrades funded by recent budgets, so expect more returns in the queue. On top of that, the agency is prioritizing security over speed, rerouting staff to fraud prevention amid warnings from experts about staffing shortages that could slow things down further. Early filers who nail everything might still wait 4 to 6 weeks or more, especially if their return involves new credits from the One Big Beautiful Bill. And here's a curveball many overlook. The IRS often doesn't ping you right away about a hold. You might check your status online and see processing for weeks, leading to frustration and unnecessary calls to their overloaded lines. Shifting gears to the next key area, these annual tweaks to brackets, deductions, and credits aren't just routine math. They're now intertwined with how your employer withholds taxes from your pay, creating traps for the unwary. Withholding is basically a rough guess based on your W-4 form, but it doesn't auto-update for things like a raise, a spouse starting work, or picking up gig income. Under the 2026 adjustments, tax brackets have inched up for inflation, starting at 10% for income up to about $11,925 for singles, jumping to 12% until $48,475, and so on up to 37% for the highest earners over $762,425 jointly. But if your withholding stays stuck on last year's settings, you could end up underpaying throughout the year only to owe a chunk when filing. This has blindsided millions in recent seasons, turning expected refunds into bills, and it's amplified now with stricter credit scrutiny. For instance, the Earned Income Tax Credit or Child Tax Credit still offer big breaks, up to $7,830 for EITC with 3 kids. But documentation must match perfectly, like proving dependents' ages or income eligibility. Families juggling multiple jobs, freelancers tracking irregular earnings, or folks with side hustles via apps like Uber are hit hardest, as partial year income can skew calculations. Even without a pay bump, crossing into a higher bracket quietly erodes your take-home if not adjusted. Retirees, though, face an extra layer of complexity here, which we'll circle back to shortly. Speaking of retirees, If you're drawing from Social Security, pensions, or IRAs, these updates pack a punch because the tax code no longer views retirement income as straightforward. Many assume their setup rolls over unchanged, but now the IRS cross-references all streams: Social Security, 401k, withdrawals, even dividend interest, against thresholds that determine taxability. For 2026, Social Security gets a 2.8% cost of living bump, pushing average monthly checks to around $1,976, but if your combined income hits $25,000 single or $32,000 joint, up to 50% becomes taxable. Over $34,000, $44,000, it's 85%. What triggers a shift? Maybe a one-off IRA pull for home repairs or bond interest spiking. Suddenly, more of your benefits get taxed without your check growing. Required minimum distributions kick in at age 73, and botching the reporting invites 25% penalties, plus IRS flags if amounts don't align with custodian reports. Medicare ties in too. Higher income from these sources could jack up Part B premiums by hundreds monthly via IRMA surcharges. The IRS's automated matching, now more robust with data from banks and SSA, spots discrepancies faster, but it's not about targeting seniors. It's precision enforcement to close gaps. Pro tip: use the IRS withholding calculator for pensions to tweak now and avoid year-end shocks. Let's clear up what enforcement really means today, because the word audit often makes people imagine stern IRS agents showing up at their door, but the reality is much different. Most enforcement actions now are automated, tech-driven, and administrative. Instead of surprise in-person visits, the IRS typically starts with a letter or a CP notice triggered by algorithms that detect inconsistencies in your tax return. Common triggers include a missing 1099 from freelance or side income, deductions that don't match reported income, or mismatched W-2 wages. Even though enforcement in 2026 will focus more heavily on high earners with incomes over $400,000, complex partnerships, and cryptocurrency transactions, everyday filers aren't completely immune. Any discrepancy in reported data can prompt a notice, which is why staying accurate and organized is essential. How to respond to IRS notices. The biggest mistake taxpayers make is ignoring these notices, assuming they are junk mail or phishing attempts. Many people do this only to later face more serious consequences, like liens on property or withheld future refunds. The smarter approach is to treat every notice as a prompt for action. Start by gathering all relevant documentation and respond within the 30-day window specified in the letter. Often, these matters are resolved online via your IRS account, making the process far simpler than most imagine. Recognizing that the IRS system is designed to ensure data accuracy, not punish taxpayers, helps remove fear and encourages proactive engagement. Understanding this modern enforcement approach can prevent small mistakes from escalating unnecessarily. Tools and strategies to stay ahead. Staying organized is the key to avoiding complications. Apps and software that track income, expenses, and deductions can make it easier to reconcile your records with IRS data. For low-income taxpayers or anyone unsure about their filings, resources like VITA, Volunteer Income Tax Assistance, provide free guidance and support. By regularly reviewing your documents, keeping digital copies of key forms, and responding promptly to any notices, you reduce the risk of escalated enforcement actions. Essentially, the system works best when taxpayers are proactive. Accuracy, organization, and timely responses keep things smooth and prevent unnecessary stress, making compliance manageable rather than intimidating. Diving into pitfalls that trip up taxpayers yearly, these aren't about intent, but the sheer intricacy of the rules amid life's twists. A classic? Rushing to file before all forms land, say a delayed 1099 from investments, and missing income, which auto-triggers a notice and possible underpayment penalties up to 25%. Or relying on generic online advice without tailoring it. What qualifies as a home office deduction for one remote worker might not for another based on square footage rules. Others brush off IRS mail, mistaking it for scams, letting fixable issues fester into audits. Assuming refunds are a lock ignores factors like new ID verification steps or the phase-out of paper checks. Now, direct deposit is pushed hard to cut fraud, with paper options fading for security. Finally, skipping withholding tweaks after events like marriage or a bonus can flip a surplus into a debt. These are fixable with habits like mid-year check-ins using the IRS estimator tool, turning potential headaches into non-issues. No need to freak out over these 2026 shifts. They're designed for efficiency, not punishment. But proactive moves now keep you steering the ship. Begin with a withholding audit. Plug your details into the IRS online tool to see if your pay stubs align with projected taxes, adjusting your W-4 if needed to avoid owing later. Digitize records with secure apps for receipts and forms, making responses to queries lightning fast. Set up or log into your IRS.gov account for real-time tracking of refunds and alerts, beating mail delays. Never ignore IRS correspondence. Every notice contains important details, like your taxpayer identification number, TIN, deadlines, or specific actions required. Responding promptly is critical to avoid compounding fees or penalties that can quickly escalate. If a letter or notice confuses you, don't panic. Take advantage of free resources, such as the Taxpayer Advocate Service or community tax clinics, to get guidance before the April 15th deadline. Developing these habits early gives you peace of mind and keeps you in control of your finances rather than reacting to surprises when it's too late. Staying proactive doesn't just prevent problems, it can also help you claim valuable deductions and credits. For example, seniors 65 and older may be eligible for the new $6,000 senior deduction, while certain purchases like US-made vehicles may allow for up to $10,000 in car loan interest deductions. These perks are part of the IRS's 2026 updates, and understanding them ensures you maximize benefits rather than leaving money on the table. The key is preparation. Knowing the rules, having documentation ready, and checking deadlines so that every eligible deduction counts. The IRS's 2026 rollout, shaped by the One Big Beautiful Bill and inflation adjustments, affects multiple areas. Refunds are increasingly electronic, owed amounts may change due to bracket shifts, and enforcement is tighter thanks to smarter technology. Filing opens January 26th and ends April 15th. No extensions on deadlines can prevent issues. Small mistakes under new rules, such as exceeding the $40,000 SALT cap or claiming charitable deductions incorrectly, can lead to fines or delayed refunds. Whether you file annually, manage multiple jobs, or help family members, staying informed now prevents pitfalls and ensures you take full advantage of deductions and credits available to you. The IRS sets timelines, not alerts, and grasping 2026's landscape, from deduction hikes to enforcement tech, empowers your choices, sidesteps shocks, and optimizes outcomes. If this breakdown helped you navigate the confusing world of IRS notices, don't just watch and forget. Bookmark this video now so you can reference it when needed and share it with your network. Friends, family, co-workers, anyone who files taxes regularly can benefit from this information, avoiding costly mistakes, penalties, or delayed refunds. Knowledge is power, and spreading it helps others stay one step ahead. Above all, subscribe to this channel for clear, trustworthy, and easy to understand IRS updates. From refund trackers and audit alerts to major tax changes and enforcement notices, we cover everything that could impact your bottom line. Tap the notification bell so you get every update the moment it's released. Don't wait until it's too late to act. Remember, staying informed now isn't just about avoiding trouble. It's about taking control of your finances, preparing ahead, and helping those around you do the same. Act today. Organize your documents, track your refunds, and empower your friends and family to stay safe and stress-free this tax season. The content in this video is for educational and informational purposes only and is not professional tax, legal, or financial advice. Always consult a licensed tax professional, accountant, or the IRS directly for guidance specific to your situation. While we strive to provide accurate and up-to-date information based on publicly available IRS resources, rules and regulations may change. The creators of this video are not responsible for any actions taken based on the information presented.